In this presentation, we will take a look at multiple choice questions related to common managerial accounting decisions and scenarios, going through the questions and then practicing test-taking skills with them. First question, we have 1,500 defective units of product that already cost $20 each to produce. A salvage of $6 each. The defects can be fixed for $7 per unit, allowing them to be sold for $23. The $20 per unit is either A, sunk cost, B, relevant cost, C, out-of-pocket cost, D, opportunity cost, or E, missed opportunity cost. Okay, so let's go through this again using the process of elimination. Now again, we might just want to glance at these types of questions, and if you just glance at these questions, we're going to say, there's numbers involved. All right, I might have to do a calculation. That would be my first thought on it. And then I'd say, well, maybe I should just go to the last sentence or look at the answers and see if the answers have numbers in them. And I look at the answers and I say, no numbers in the answers. That's unusual. Let's look at the last sentence about, what they're asking for. And then we might want to do that actually before we read a long problem like this. Otherwise, you're reading through the problem with no really objective in your mind. You're just going to have to reread it again. You might want to read the last sentence first, have the objective in your mind, then read the problem details with that objective there. It might save a little time. So the $20 per unit is A. So we're looking at the $20 per unit number. So considering this $20, that's the one we want. We're zeroing in on that as we do so. Let's read through this again. We have 1,500 defective units of product that already cost $20 each to produce. So the fact that it has some key terms, already cost, of defective products. So we have this, we already know what type of question this should be if we've seen a few of these. If we've worked a few of these, we're going to say, this is a defective product question, meaning we have these defective products, and I would expect the question to be, should we sell them now, dispose of them, or fix them? And of course the question is the added costs versus the benefits of fixing them. And in a question like that, you're always looking for the idea that the costs up to this point are over, they're done, they can't be changed. Therefore, this 1,500 and the 20, the defective units, or the $20 cost per defective unit, is not relevant to the decision-making process because we're here, we're at where we're at. It is what it is. And that's kind of the trick to this type of question. We just say, okay, the $20 irrelevant as of now. What's the term that means irrelevant? Either sunk cost, relevant cost, out-of-pocket cost, opportunity cost, missed opportunity cost. So it's not going to be a relevant cost. No, it's going to be irrelevant. Out-of-pocket cost, that would be a future cost. This is a past cost. Opportunity cost is the cost of a second alternative, another opportunity. But it doesn't necessarily mean something in the past. And a missed opportunity cost, you might argue for that because we missed an opportunity because we messed up in the production in the past. But again, that's not a term really. So that's not what we're looking for. We're looking for the sunk cost. It's going to be sunk. It's a past cost, not relevant, not relevant to this decision-making process. Final answer, we have 1,500 defective units of product that already cost $20 each to produce. A salvage of $6 each. The defects can be fixed for $7 per unit, allowing them to be sold for $23. The $20 per unit is a sunk cost. Okay, next question. Product A requires 5 machine hours per unit. Product B requires 3.3 machine hours per unit. Product A sells for $17.60 per unit and has variable costs of $6.60 per unit. Product B sells for $13.20 per unit and has variable costs of $5.50 per unit. If we can sell as many units of either product, we should either A, produce only product A, B, produce only product B, C, produce 60% A and 40% B, or D, produce 40% A and 60% B. So if we look at problems such as this, on first glance, we might look at it and say, hey, we got a lot of numbers here. Let's look at the answer and see if there's numbers in the answers. Seems like it's a lot of text in the answer. Then we might want to go to the final sentence before we go through it again and say, if we can sell as many units of either product, we should. So that means we're looking for this kind of product mix type of problem. So if we do a few of these, we're going to say, all right, this is a product mix type of problem. We're going to have two products. Our question here is to figure out which of the two we should produce, or what mix should we produce. Usually in a problem like that, we'll have some type of restraint, some type of bottlenecking activity, that being the machine hours here. So we're going to consider this with regard to that bottleneck, those machine hours. Our goal here is typically to have the contribution hour per the restraint, in this case per machine hour. So we're going to have to figure out the contribution margin per unit, which is going to be the sales minus the costs, and then we're going to take into consideration the machine hours to get the contribution margin for the machine hours. All right, so we're going to say A and B was where we'll start off. These are going to be our two products. And product A has 5 machine hours per unit. Product B has 3.3 hours per unit. Product A sells for, so we're going to have the sales price. That's what we're looking for. That's what we want to see. 17.6. Now we're going to have to add decimals to work this problem. So I'm going to select these cells, Home tab, numbers, adding decimals like so. So 17.6 and variable cost of 6.6. That gives us a contribution margin. Contribution margin 1760 minus the 6 is going to be the $11. Going to go ahead and underline this, Home tab font and underline just because. Keep it clean for us here. And then we're going to say product B sells for $13.20, and has variable cost of $5.50. We can go ahead and underline that, Home tab font and underline. Subtracting those out to give us the contribution margin. There we have it. Now we're going to take into consideration our restraint, that being the machine hours. The machine hours for product A, 5. Machine hours for product B, 3.3. Now we're going to divide this out. I'm going to go ahead and underline these two cells once again. And this is going to give us the contribution margin per machine hour. And that's going to be equal to the 11 contribution margin divided by the machine hours of 5. That's going to be 2.2 for this one. We're going to say that's A. 7.7 contribution margin divided by the machine hours of 3.3. That's going to give us the 2.33 for the second item. So given this information, we'll typically use the higher contribution margin per machine hour per the restraint, which is going to be 2.33. So all else equal, given these conditions, we're basically going to produce this item B as much as we can have demand for, as much as we can sell them for. There's no restraint that's given on how much we could sell for. Therefore, we're just going to produce B as long as we think there's a demand for the purchase of it. Once we get to that demand, then we would stop there and then go to A. So we're going to produce B as much as we can, as much demand as there is for it. So that would be the answers being A, produce only A, no, produce only B. That looks like the 1. Produce 60% A, 40% B. Now, this is a scenario that could happen if they gave us some kind of restraint, such as basically a restraint on how much demand there is for B, so then we'd have to stop at some point. So it's going to be B, final answer.